Today is March 24th, and this is the ADM Investor Services Weekly Market Wrap-Up. Today's guests are Alan Bush, Senior Financial Economist at ADMIS, and Dennis Smith, Agricultural Expert and Senior Account Executive at Archer Financial Services. Remember, the opinions expressed here today are solely the opinions of our guests and are not necessarily the opinions of Archer Financial Services, ADM Investor Services, or Archer Daniels Midland Company. Alan, 4 Federal Reserve spokesmen made hawkish interest rate comments this week. How do you reconcile this with last week's very dovish Federal Open Market Committee statement?
Okay, well, apparently the reason for the comments this week from those 4 Fed spokesmen basically is that they're trying to walk it back from what the Fed said at their policy meeting last week. And at that meeting, the Fed indicated that they saw only 2 rate increases this year instead of 4 that they had predicted last December. So it seems like the market's overreacted with stock indices moving up in response to that statement. So the Fed apparently thinking that it was a little bit too dovish, and this is an attempt to even things out a little bit.
I know there's a large grain report next week, March 31st, I believe. Dennis, you've noted that you're somewhat bullish toward the grains, corn in particular. Are you bullish toward corn prices because the funds are holding large, if not record large, short positions?
Actually, it's not a good enough reason to be bullish, in my opinion. The funds are coming out of short positions. In soybeans, for example, they've completely reversed, covered a large short and now slightly long the market, driven the soybean market up 30 cents or more. Corn futures have rallied, but not nearly to the magnitude. When you look at corn eating stocks, both U.S. and world, we've got a large supply of grain. Corn, beans, wheat, feed grains. I don't see it to be a reason to be bullish. If the funds are short, it's because they were in a downtrend, and I don't see anything to knock us out of that downtrend right now.
Maybe weather? I mean, is weather about the only thing that can make an impact, come moving here into planting season and then, of course, throughout the summer?
It's going to take a big event. Weather would be the most logical. A lot of people want to focus on Brazil, the political unrest there. But in terms of changing crop sizes, the political unrest in Brazil does nothing to increase or decrease the size of the corn crop. It does nothing really to increase or decrease corn demanded. So we're looking at a relatively flat demand situation for corn, a record large crop, could be another above trend line yield year, probably larger acreage. We'll find out more on acreage March 31st. I'm hard pressed to be bullish the grains right now.
And Dennis, widely known as an expert in the livestock markets, pork production was record large last year, and it's projected to be record large again this year. However, lean hog futures are currently enjoying an uptrend. How can you explain this?
Yeah, it's been a pleasant experience for the hog producer. Again, back-to-back record large production years. We are in an uptrend. We have a hog and pig report coming out, and that's going to shed some light on supplies. We think that the pig crop, the winter pig crop, was probably a bit smaller than expected due to cautious farrowing intentions and farrowing rates, and to some disease problems that was prevalent throughout the Midwest, primarily in the northern Midwest. So a smaller pig crop combined with good demand, and you can't underrate pork demand right now. Pork is cheap. Pork cuts, almost all cuts with the exception of bellies, are trading below their 5-year average, and the market responds when something is offered to the marketplace at a low price. The market responds with increased quantities demanded.
So not to press, but if you're a producer or a speculative trader right now, is there something someone can do in the markets? I mean, what kind of position would one look to take in either corn or the hog market?
Well, in the hog market, first of all, we are focused on keeping the eye on the ball, and that is production will be record large this year. If you have a profitable situation, especially in the fall time frame when we could have a severe glut of hogs, we are actively pursuing hedge strategies right now. We use a lot of option window strategies, buying puts and selling calls in that fall time frame. It's a good way to lock in a profitable window. We haven't started hedging yet in the summer hog market. We will if prices shoot higher, say between now and early May.
Great, Dennis. One more follow-up. I mean, staying with the meat markets, one of the more volatile markets really over the past 18 months has been the cattle market. Is the volatility in live cattle futures expected to persist? If so, will live cattle grab hold and join hogs in the uptrend?
Well, we think we're probably looking at an increased production situation for cattle. It's going to be a downtrending market, and I have to assume the volatility will continue to persist in both live cattle and feeder cattle futures. Some measures have been taken to try to shore that up, but you're looking at record large pork production, record large poultry production, increasing beef production, and you have to be prepared for a downtrending market with volatility wrapped up in that.
Turning back to you, Alan, the gold market advanced over $240 from the low that was made in early December. However, in the last 2 weeks, gold futures have declined over $38 from the recent $12.88 high. What's the outlook now for gold?
Well, first of all, the reason for the break off of the highs was the hawkish Fed of this week, with, as we mentioned, those Fed spokesmen talking about an early rate increase, possibly as early as in the at the April meeting. So that was the reason why we came off the highs. Longer term, though, we are seeing inflation ticking up around the world, and I'm mainly talking core inflation levels in quite a few global economies around the world. So I think that influence is going to dominate. Plus, we do have low interest rates around the world, even though the Fed will be probably raising rates later this year. Elsewhere in the world, central banks are extremely accommodative. So I am very bullish on the gold market. In fact, I think we will see some new highs for the move above that 1288 level within the next 2 to 3 months.
And finally, Alan, people always want to know about the stock market and the indexes that follow it. You remain long-term bullish. The January indicators for stock market futures were all bearish. What are the January indicators and why are you ignoring them?
Okay, first of all, the January indicators, they're basically 3 signals that take place in the month of January that often dictate the trend for stock indices for the rest of the year. The first one being how the S&P trades in the first business day of January, and of course that was a big down day. Second one is how the S&P trades in the first week, and of course that was down for the week. And the third indicator is how the indices did in the month of January, and that was also a bearish indicator. Now, we feel that those 3 sell signals should be ignored, and they should be ignored because of the interest rate influence, which always dominates at all times except when there's some type of geopolitical event. So with interest rates low globally, we are not following the January indicators. In fact, it was just earlier in the week that we did see some new highs for the year in the S&P. In fact, S&P was up on the year, which to some degree negated the January indicators. Now we backed off a little bit. So with the interest rate influence, the dominant factor, we are expecting higher prices for the rest of the year. And I do think all of the major indices will be trading higher on the year.
Well, we thank both of you today, and we wish you all a happy holiday weekend. Remember, the opinions expressed here today are solely the opinions of our guests and are not necessarily the opinions of Archer Financial Services, ADM Investor Services, or Archer Daniels Midland Company. If you have any questions or comments or would like to know more about our services, please contact us at www.admis.com.